Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, so imagine you just went to sleep back in 2023.
Okay, I'm picturing it.
Right, and back then, AI was just this magical, invisible software. It wrote your emails, it passed the bar exam, that kind of thing.
It was all digital, just code on a screen.
Exactly. But now, imagine waking up today, here in July of 2026, to find out that AI has basically mutated.
Mutated how?
Well, according to recent analysis, it has become the heaviest, most expensive, most debt-fueled physical construction project in human history.
Wow, that is a total shift from just a few years ago.
It really is. I mean, it is no longer just a high-flying tech story for the stock market. It has actually become a massive, honestly terrifying digestion problem for the global bond market.
I love that we are starting right there because, if you only look at your stock portfolio, you might think everything in the AI world is just pure upside.
Right. The stocks look great on the surface.
Yeah, but when you look at the underlying financial data today, the entire ecosystem is being force-fed an unbelievable amount of corporate debt, and the system is seriously struggling to swallow it.
So true. And to really grasp the scale of what is happening,
Yeah.
we have to look at something called CapEx.
Right, capital expenditure. And for anyone who, isn't a Wall Street accountant, let's use a simple analogy here.
I love a good analogy. Let's hear it.
Think of CapEx like opening a brand new pizza shop.
Okay.
You have your day-to-day operating expenses, right? Like buying flour, paying the teenager behind the register, keeping the lights on. That's regular spending.
The stuff that keeps the business running every day.
Exactly. But before you can even open the doors and sell a single slice of pizza, you have to spend a literal fortune. You have to buy industrial ovens, purchase the building, buy a fleet of delivery cars.
All that upfront heavy lifting.
Right. All of that massive upfront money spent on physical assets, that is your CapEx.
And right now, if you look at the data, the biggest technology companies in the world are buying a mind-boggling number of ovens just to keep their AI ambitions alive.
Just massive amounts of hardware.
Yeah. And this transition, it is fundamentally rewiring how global finance operates.
I mean, I know these companies are spending a lot, but how much are we actually talking about? Put some numbers to this pizza shop for me.
Well, let's look at just the four major hyperscalers: Microsoft, Alphabet, Amazon, and Meta.
Just those four.
Just those four. The data projects that they alone will spend roughly $725 billion on AI infrastructure this year.
Wait, $725 billion
Yep.
in 12 months, just on physical stuff?
Just for those four companies in 2026. And it gets crazier.
How so?
When you zoom out and factor in the broader ecosystem, so the independent data center operators, the specialized semiconductor supply chains, the massive power grids, the cooling networks, so these computers don't just physically melt.
Right, you need all the supporting infrastructure.
Exactly. Market estimates show that number climbing to somewhere between $800 billion and a full $1 trillion for the year.
$1 trillion. I mean, just to put a finer point on this, I was looking at Alphabet's recent filings the other day.
Oh yeah, their updated guidance.
Yeah, they casually bumped up their 2026 CapEx guidance. They were telling investors they'd spend maybe $180 to $190 billion.
This is already a huge number.
Right. Then they just came out and said, actually, let's make that $195 to $205 billion. They just added $15 billion to the shopping list like it was literally nothing.
But here's the mechanism you have to understand, because this creates a very serious cash flow problem.
Okay, break that down for me.
We know these tech giants print money, but their spending is drastically outpacing their income.
By how much?
Well, if you look at consensus estimates for this year, these companies might grow their operating cash flow by about $340 billion. But their CapEx is growing by over $534 billion.
Wait, let me do the math on that real quick. So for every $1 of new operating cash flow these companies are bringing in, they are being forced to spend $1.57 on physical infrastructure.
That is the exact ratio. $1 in, $1.57 out.
Okay, let's unpack this. Because if I am spending 150% of my paycheck, that math doesn't work for very long.
No, it really doesn't.
It's like getting a massive promotion at work, right? So
Right.
you have a fantastic salary, literally the best you've ever had.
You're feeling rich.
Exactly. But then you decide to do a luxury renovation on your house. And every single month, you are spending 150% of your new paycheck on contractors and marble countertops.
Right. It doesn't matter how good your salary is at that point.
Exactly.
Yep.
Eventually, your checking account hits zero and you have to start swiping credit cards just to keep the construction going.
What's fascinating here is it really reveals a total identity crisis for the tech industry.
What do you mean by identity crisis?
Well, for the last 20 years, we thought of these companies as software businesses, right?
Yeah,
And software is a beautiful business model.
because it's so cheap to make.
Right. You write the code once, and distributing it to 1 billion people costs you practically $0. It's a world of high profit margins, intangible assets, and mountains of free cash flow.
You literally just copy and paste it.
But AI is not software. AI is heavy industry.
Right. It takes real-world resources.
Exactly. To actually create and run these AI models, you have to buy real, physical, incredibly expensive hardware.
Like the chips and servers.
Yeah, you need hundreds of thousands of GPUs, high bandwidth memory chips, acres of concrete data centers, and just gigawatts of electricity.
So it's more like building a factory than writing code.
Exactly. The tech sector has morphed from this nimble, high-margin software game into a heavy, capital-intensive industry. And heavy industries require a mountain of debt.
Okay, this brings up the most obvious question then. If I'm spending $1.57 for every dollar I make, where is that extra 57 cents actually coming from?
That is the trillion-dollar question.
Because even for a giant like Amazon or Meta, they can't just wish that money into existence.
Right. They are getting it from the corporate bond market. They're borrowing it.
Just taking out massive loans.
Yes, but they're using highly complex financial structures to do it. Specifically, things called special purpose vehicles, or SPVs.
Okay, what exactly is a special purpose vehicle and how does it help them?
Think of an SPV like a tech giant setting up a completely separate, legally isolated mini company.
Like a shell company.
Sort of, yeah. The only purpose of this mini company is to hold the mortgage for a new data center.
But why go through all that trouble?
They do this to keep the massive new debt off their main balance sheet. They want their core financial statements to still look pristine and profitable for the stock market investors.
I see. So if the AI data center goes completely bankrupt, the lenders can repossess the building, but they can't come after Meta's main piggy bank.
In a simplified way, yes. It's project financing.
Interesting. Do you have an example of one of these?
Yeah. For example, there is a massive $12 billion data center project in El Paso involving Meta and BlackRock.
12 billion. Wow.
Yeah, and the data shows they used an SPV to issue bonds for this project, and the yield they had to offer investors was roughly 7.5%.
7.5%. I mean, that is a huge payout for an investor.
It really is.
Which tells you the lenders perceive a lot of risk, right? You only pay 7.5% interest if you can't get a cheaper loan.
Precisely. And that yield was about 0.4% higher than a very similar deal done just a few months prior.
So the cost of borrowing is already going up.
Yeah. The lenders are demanding more money because the bond is backed by a 20-year lease agreement from Meta. But the bondholders have very limited direct claims on the physical assets if something actually goes wrong.
So the tech companies are basically quietly piling up debt in the background.
Yep, and the bond market is frankly choking on the sheer volume of it.
How much volume are we actually talking about here?
Well, recent analysis shows AI-related debt is approaching 15% of all U.S. investment-grade corporate bond issuance for the entire year of 2026.
Wait. 15% of the entire American corporate debt market is just AI construction?
It gets wilder.
Oh, boy.
The Bank of England issued a financial stability report recently. They pointed out that the hyperscalers issued more investment-grade debt in just the first half of this year than they did in the entirety of 2025.
That is insane.
And if you add up all the global currencies, the debt issued by these tech giants since January is roughly equal to the total debt issued by the entire UK government in that same time frame.
Hold on, are you seriously comparing a search engine company's debt issuance to a sovereign nation?
The numbers do not lie. They are literally borrowing on the scale of sovereign nations.
Okay, I have to pause you right there and ask a question for the everyday listener.
Sure, go ahead.
Let's say I'm a regular person with a 401k, right? I don't buy risky tech stocks. I don't want anything to do with the AI hype.
You just want safe returns.
Exactly. I buy a super boring, highly diversified U.S. corporate bond index fund. I think I'm playing it incredibly safe, just clipping my little interest coupons.
Right.
Are you telling me that I am secretly betting my retirement on whether these AI data centers succeed?
I am telling you exactly that. And this hidden concentration risk is absolutely terrifying credit analysts right now.
How did that even happen?
Well, these hyperscalers have historically high credit ratings. So because they are issuing such massive amounts of debt, they are swallowing up larger and larger portions of global bond indexes.
So they just take over the index.
Yeah. You look at your retirement portfolio and you think you are diversified across hundreds of different industries. But functionally, your portfolio is becoming a massive leveraged bet on U.S. non-financial AI infrastructure.
It's like thinking you bought a healthy smoothie with 50 different fruits, but it turns out it's just 90% artificial banana flavoring. You aren't diversified at all.
That's a great way to put it. And the borrowing is so severe that the U.S. dollar bond market actually can't handle the supply anymore.
They tapped out the U.S. market.
Pretty much. The hyperscalers are having to go overseas to find enough buyers. Since early 2025, they have issued roughly $80 billion in debt in non-dollar currencies.
So they're issuing bonds in British pounds, euros, and Japanese yen.
They have to. They are spreading the burden across the European, British, and Japanese bond markets. But that also means they are spreading the AI risk globally.
Which is really interesting given the current political climate in the U.S. right now.
Oh, absolutely.
I mean, we have the Trump administration focusing heavily on domestic growth, managing U.S. interest rates, and really prioritizing American manufacturing.
Right, trying to keep capital and production inside the borders.
Exactly. But these tech giants are essentially running their own private, borderless economy.
They really are. And if this AI infrastructure boom hits a wall, it's not just a localized American tech problem anymore. It becomes a global credit event.
Which means lenders globally must be getting incredibly nervous. I mean, if I am loaning someone billions of dollars and I see them going to Europe and Japan just to max out more credit cards, I am going to start charging more interest.
And that is exactly what the data shows is happening. About 79% of the hyperscaler sector bonds issued since early 2025 are now trading at what we call wider spreads compared to their very first day of trading.
Okay, let's define a wider spread so everyone can picture this.
Go for it.
If you ask your best friend to borrow $10 for lunch, they probably aren't going to charge you interest. The risk that you'll steal their $10 is practically zero.
Right, it's just $10.
But if you ask that same friend to borrow $10,000 to start some sketchy crypto business, they are going to demand some serious interest, right?
Absolutely.
Because the risk of losing their money is much higher. That difference in the interest rate, that risk premium, is essentially the spread.
That is the perfect mechanism to keep in mind. When these AI bonds first launched a few years ago, the market treated them like lending $10 to a friend.
Because they're the biggest companies in the world.
Exactly. These are trillion-dollar companies. Alphabet, Meta, Microsoft, they were viewed as incredibly creditworthy. Their bonds used to trade almost like risk-free U.S. Treasury bills.
But that changed.
Completely. As the sheer volume of the borrowing skyrocketed, and the CapEx estimates kept getting revised upward every single quarter, the bond market woke up.
So the lenders got spooked.
Yeah. The spread is widening because lenders are demanding a higher interest rate to compensate for this terrifying new risk profile.
I want to talk about another metric that proves this risk is real. Earlier, you mentioned that these companies have massive operating cash flow, meaning their actual businesses still make money.
Right, they're still hugely profitable at their core.
But the data shows that Alphabet and Tesla recently recorded negative free cash flow. What is the difference between operating cash flow and free cash flow, and why does it matter?
So operating cash flow is the money the business generates from its normal operations. Selling ads, selling cars, selling software.
The money coming in the front door.
Right. Free cash flow is the cold, hard cash left over after you pay for all your CapEx.
I see.
So Alphabet and Tesla are still making billions from their core businesses. But their AI infrastructure spending has become so astronomically huge that it wiped out all of that incoming cash and then some.
Wow.
They dipped into negative free cash flow because the physical construction costs exceeded the money they printed.
When companies that are famous for printing money suddenly start bleeding cash, that sounds dangerously close to a bubble.
You're not wrong, and some major financial institutions are using that exact word.
Really?
Yeah. Analysts at PIMCO recently compared this massive AI buildup to the 1990s telecom bubble.
Oh, that didn't end well.
No, it didn't. They looked at recent corporate filings and found that these tech giants have an astonishing $822 billion in hidden future lease commitments that aren't even fully recognized on their balance sheets yet.
$822 billion in leases.
Yep, and that number jumped up from $675 billion just a few months prior.
Let's explain why an $822 billion lease commitment is terrifying. A lease commitment is basically a legally binding promise to pay rent, right?
It is a promise to pay rent on a massive, specialized data center for the next 15 to 20 years, regardless of whether your AI product actually makes a profit.
So you're on the hook no matter what.
Exactly. If you sign a 20-year lease on an office building and your business fails, you still owe the rent.
And that's what happened in the 90s.
Yeah, the telecom companies in the 90s laid millions of miles of fiber optic cables, assuming everyone would need high-speed internet immediately.
And they were right, eventually.
Eventually. The internet was real, but the demand took a decade to catch up. The companies went bankrupt, paying for infrastructure they couldn't fill. The bond market is terrified. The hyperscalers are doing the exact same thing with AI data centers right now.
So is AI just fake then? Are we building all these data centers for a product nobody wants?
No. If we connect this to the bigger picture, the technology is very real. The hyperscalers today have billions of active users and massive enterprise cloud clients.
So people are using it.
Yes. The difference between now and the 90s is what economists call the J-curve.
The J-curve. Okay, explain how that works.
So if you look at adoption metrics across the S&P 500, a decent chunk of companies, about 11%, have deeply integrated AI into their core business processes.
So adoption is definitely happening.
It is, but the J-curve dictates the timeline of profitability. Imagine the letter J on a graph.
Okay, drawing it in my head.
When a company adopts a massive new technology, the costs hit immediately. You have to pay for the CapEx, the energy bills, the software licenses, and the employee training.
So the line goes straight down.
Right. Your profits take a massive dive downward, forming the bottom hook of the J.
And eventually, you hope the line swoops back up into massive profits as the productivity kicks in.
Yes. So the bond market isn't saying AI is a fraud. They are just looking at that deep, incredibly extensive valley at the bottom of the J-curve and asking, are we sure these companies can afford to bleed cash long enough to reach the upward slope?
They're worried about surviving the bottom of the J.
Exactly. The core question has shifted from, is AI real, to at what speed and at what profit margin will this infrastructure actually pay for itself?
Which brings us to the most fascinating contradiction in this entire story.
What's that?
Right now, stock investors and bond investors are looking at the exact same AI investments, the exact same CapEx numbers, and the exact same J-curve, but they are coming to completely opposite conclusions.
It is the ultimate divide between equity markets and credit markets.
It's like watching someone put a massive 3-story addition onto their house.
I like this.
The stock market investor is like the real estate agent standing on the lawn saying, wow, think of how much this house is going to be worth in 10 years. It's going to be a mansion. Let's raise the valuation right now.
Right, dreaming of the future.
Exactly. But the bond market investor is the bank underwriter looking at the mortgage document saying, this is insane. How on earth are they going to make these massive monthly payments right now?
That is a perfect way to look at it. And to take that a step further, think about the underlying psychology.
Okay.
Stock investors are like venture capitalists. A venture capitalist is perfectly happy to lose money on 9 out of 10 ideas, as long as the 10th idea is the next iPhone.
They want that home run.
Exactly. They buy the dream, and they tolerate massive risk for infinite upside.
But bond investors don't get infinite upside.
Not at all. Bond investors are like your local bank manager. They don't care if your AI company can cure diseases in the year 2030, and they don't care if your stock goes up 1,000%.
Right. They just want their money back.
Yep. They only care about one thing. How are you going to make your $50 million interest payment next Tuesday? Bond investors buy the math. They focus entirely on downside risk and immediate cold, hard cash flow.
So if the stock market is cheering and the bond market is having a panic attack, who usually wins that fight?
Historically, the bond market is the canary in the coal mine. They are the ultimate enforcers of reality.
The enforcers? Wow.
Yeah. If a tech company's stock drops 20%, the company can still function. But the moment the bond market starts refusing to fund these AI projects or starts charging 9 or 10% interest because the risk is too high, the entire system breaks down.
Because the money printer gets turned off.
Exactly.
Yeah.
If the bond market cuts off the supply of cheap capital, the hyperscalers are forced to slow down their CapEx.
And if they slow down CapEx,
The rollout of new AI infrastructure slows down. And if the AI rollout slows down, all those sky-high stock valuations based on infinite growth will just collapse.
it's all a house of cards tied to the debt.
Yes. This is why everyday investors, even if they only own tech stocks in their portfolio, need to look past the flashy ticker symbols. You have to watch the boring structural bond market. The health of the entire AI boom currently relies on the bond market's willingness to keep footing the bill.
Well, let's recap the incredible journey we've just been on. The narrative around AI has completely shifted. It is no longer just a fun, high-margin software story that boosts your tech stock.
Nope, those days are over.
It has transformed into a heavy, capital-intensive, debt-fueled construction boom. These hyperscalers are spending hundreds of billions of dollars, honestly nearing $1 trillion, on physical infrastructure.
Ovens for the pizza shop.
Exactly. And they are doing it by dumping unprecedented amounts of debt into complex vehicles in the global bond market. And while the stock market is dreaming of a sci-fi future, the bond market is looking at negative free cash flow and demanding higher interest rates.
They're wondering how long this massive spending spree can last before the cash just runs out.
Exactly.
The focal point of AI analysis has officially moved from the income statement to the balance sheet and the cash flow statement.
So what does this all mean for you? I want to leave you with a final thought to mull over today.
Let's hear it.
We always hear about the race for better microchips, faster algorithms, and smarter models. But if the true bottleneck for the future of AI isn't the technology at all, if the real limit is simply the global bond market's willingness to keep lending tech companies billions of dollars, who actually controls the future of AI? Is it the visionary tech CEOs in Silicon Valley? Or is it the incredibly boring, math-obsessed bond investors on Wall Street?
If the money stops flowing, the innovation stops building. It's a terrifying amount of power.
Don't forget to subscribe and hit that like button.